Hey guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So if you're new to the channel, I focus on stock market investing, personal finances and analysing individual stocks as well. So if this is the kind of thing that you're interested in, it'd be great to see you on the channel. So please leave any comments, and if you enjoy the content, also consider subscribing as well, because that really helps me out with building the channel. So let's get on to today's video. For this week, we're going to focus on exchange traded funds, or more commonly known as ETFs. So we're going to look at what is an ETF, the different kinds of ETFs, who are the main providers of ETFs, have the pros and cons as well, and just a few things to watch out for. So the first thing we need to look at is what is an ETF. So an exchange traded fund is essentially a basket or collection of securities that are sort of bundled together into one fund. It's a good tool if you want to be able to invest in, for example, a whole market or a whole index. So for example, if we look at the S&P 500, which is made up of 500 of the largest US companies, then obviously if we wanted to individually own a piece of each company, we'd be paying tens of thousands, if not more, of dollars to actually get that. So what we get with the ETF is, this is kind of all divided up into sections. So we're buying an ETF which replicates the index itself. This is good because it allows us to get exposure to the market and also get the broad diversification that the whole index offers, in the example of the S&P 500 or perhaps the FTSE 100 in the UK as well. So the exchange traded part of this means that it trades on a normal stock exchange, just like other shares. So due to that, it makes it very easy to buy and sell ETFs, because it's the same as if you're going buying or selling stock of an individual company. You make money the same way in ETFs as you do in stocks, so you can get the capital gains where the stock appreciates or the ETF appreciates in value, and then you can sell it on for a profit. Or otherwise, some ETFs will also track dividends as well. So they might track a group of stocks which are high dividend stocks in a particular market, so that returns value to you in the form of dividends as well. So those are the kind of two main ways that you can make money from investing in ETFs. So there's now a huge amount of ETFs in the market. Around 2017, if we look at this graphic, we can see that there was just under 300 ETFs, and now kind of towards the end of 2019, so last year, I'm sure this has actually increased since then, but there was around just under 7,000. So you can see that this is a really increasing area of the market as well. So here we can look down the biggest ETF companies. So here we've got iShares. iShares is actually a part of the BlackRock group. So we can see here that they've got 1.8 trillion of assets under management. And then we go down, we see also Vanguard, 1.3 trillion, 80 ETFs offered, and then State Street, also Invesco, and then Charles Schwab. So what I would recommend doing is go and take a look at these websites, and then you can have a look through and see different ETF offerings. Obviously, you might see quite a lot of similarities as well in the kind of things they offer, like the indexed ETFs and also the sector ETFs. But it's good to go and look through those to get an idea of what they offer as well. What you'll also notice is obviously there's so many different ETFs that they all have some objective built into them. So if we can see from the screen here, I'm showing the iShares Core High Dividend ETF. So the investment objective here is to track the investment results of an index composed of relatively high dividend paying US equities. So equity basically means a US stock. And you'll also see a lot of different types of ETFs. I mean, the main ones, the kind of most popular ones that are traded on the exchanges, they're the kind of equity ETFs. So that's might be an ETF tracking an index or a sector. So like I gave you an example earlier, the S&P 500, or could be the FTSE 100 in the UK, which is made up of, like the ETF would be made up of all of those companies within the index. Or you can actually get sector ETFs as well. You might not know which particular company you want to invest in healthcare. So you might want to kind of bet on the whole market without you having to be able to pick the winner or to pick the best company within that, you could actually just get a broad share of the healthcare market just from investing in that ETF. So apart from the stock or equity ETFs, you can also get bond ETFs, commodities. So that's kind of, obviously with commodities, it would be farming products, soybeans, milk, livestock, could be precious metals, gold and silver, or industrial metals like zinc, copper, that kind of thing. That's what commodities are. So you can also invest in those as ETFs as well. You can also get currency fund ETFs. So if you're invested in a lot of US stocks, you could get like other currency ETFs which kind of hedge against a devaluation of the US dollar. So that's to kind of protect your portfolio from currency drops. You can also get real estate ETFs as well. So normally real estate investment trusts, they're normally called REITs. So that's kind of buying into companies who do property development and things like that. So that's another ETF you could invest in as well. And then you also get the specialty ETFs. Now, from what I've seen from looking into them, they can get a little bit more complicated. You can actually get ETFs which follow the inverse of the stock or the inverse of the index. So rather than you're investing in the ETF and you think the market's going to go up, you can get an inverse ETF where you're investing in it and you make the money if the stock market actually goes down. So let's take a look at the pros and cons of ETFs. So firstly, we can see that they provide easy diversification for low minimum investment costs. So you can get started with as little as a few $100s. I think the SPY, which tracks the S&P 500 index, you can buy that for around $360 at the moment. So that's kind of quite an easy entry cost for a lot of people. So the ETFs are easy to buy and sell as they trade on an exchange just like other stocks. And the third one here is they have a low expense ratio. So there's one caveat here because the expense ratio is low when you compare to mutual funds, but mutual funds are obviously actively managed funds. So there is someone who's actually checking what stocks and bonds and things are going in and out of the portfolio. So obviously you would expect an actively managed fund to have a higher expense ratio. And now let's look at the con side. So the disadvantages of ETFs are that the returns are limited because by nature they're designed to track a certain market or sector. So if the ETF has been designed to track the S&P 500 or, for example, the healthcare sector, then obviously it will just mirror as closely as possible the rises and falls in that particular sector or index. So obviously you can't really outperform something that you're designed to track. So that doesn't give you opportunities to kind of have better returns than the market return. Because the ETFs trade like stocks, it can kind of create a temptation to trade them more frequently because it's easy to do that. So obviously if you're taking part in more trades in the ETFs, then obviously that can eat away at the advantage because you're getting transaction fees as you buy and sell those as well. So generally, I think ETFs are really good. They offer like a very broad kind of access to different markets and give you obviously the diversification as well. What you want to do also is kind of avoid becoming overexposed to the same markets or industries. So we can take a look at an example that I'll put on the screen now. So this example shows a couple of different Vanguard ETFs. The first is the Vanguard ETF VOO, which is the one that tracks the S&P 500. Now, if you look at the largest kind of makeup of all the stocks here, we can see that Apple, Microsoft, Amazon, Alphabet, Facebook, Berkshire Hathaway, Johnson & Johnson, Procter & Gamble, Nvidia and Visa. So these 10 companies make up 28.9% of the total net assets of this ETF. We also take a look here at the Vanguard Information Technology ETF, and we can see that there's some of the same companies across here. So we've also got Apple, we've also got Microsoft, also Nvidia, and also Visa. So if we're invested in both of those funds, then obviously we've kind of got too much exposure to these companies. So obviously if the S&P is going down, the highest weighting of these is with those like larger information tech companies. So you can see that if they go down, then obviously the other ETF will go down as well. So we've kind of got double the exposure to those. So if you don't understand the ETF, I would definitely steer clear of it as well, particularly these ones that have got the inverse ones, and they might get a little bit complicated to track. You should also look at the kind of investment objective of the ETF, and also check how the weighting is done for each company, because you probably won't find even weighting across all the companies. The biggest companies in the sector or the index, they'll have a higher weighting within how everything is split. The same as if you're looking at individual stocks or any kind of investment, you should also do due diligence to make sure that you understand what you're investing, you understand the risks, because investing in anything always carries a certain amount of risk. And that's what I would say just to keep an eye on particularly. So once you've found an ETF that's a good match for what you're looking for in an investment, I'd recommend that you also check out my dollar cost averaging video. So I kind of give some strategies towards that and kind of how you can improve your returns from slightly changing the strategy there. And so I'll put a little link to the video. You should be able to see it on the screen. So I'd recommend watching that as well, so you can get an idea of the capital allocation and different methods of doing that. So if you enjoyed the content, please like and consider subscribing as well, because that also really helps me out with the YouTube algorithm. Also, leave any comments you have. It's always good to see different opinions and different viewpoints on this kind of thing. I'm trying to get like a broad perspective from everyone, so any feedback is always welcome. So thanks for watching, and I'll see you in the next video. Cheers.